Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this Analyze Out Loud video, I'm going to look at 6 reasonably valued Dow stocks. My first example is American Express, but I'm also going to look at General Electric, Jpmorgan, the 2 pharmaceutical giants, Merck and Pfizer, and then finally Property and Casualty Insurer, Travelers. But let's start by looking at American Express here and just orient those who aren't familiar with FastGraphs to the graph. I've got a plotting of earnings per share here at a 15 PE ratio represented by this orange line. I want you to notice the 2 rather precipitous drops during the Great Recessions. And then I'm going to next bring in the dividends. And you can see the company has steadily paid dividends over this time frame since 1998. But they did freeze their dividend during the recession of 01, and they froze it again at 72 cents during the recession of 08. Next, I'm going to stack dividends on top of the orange line because this is the dividend payout ratio. The area below this, you can see Jpmorgan has a relatively low payout ratio in about the 20% range just visually by looking at this graph. And then next, I'm going to bring in monthly closing stock prices, and I want you to notice high valuations back here, excessive valuations during this period. During the recession, a precipitous drop in stock price. This was over an 80% drop in value from here to here. Every time they've had an earnings drop, that's always led to very steep price drops. That's something you should be aware of. And then I'm going to bring the normal PE here because there's a pretty valuable lesson here also. If you look at American Express's normal PE ratio, you see that it was around 18.7 is the blue line here. It was relatively higher prior to the Great Recession, but then you can clearly see the stock price is trading below both the blue and the orange line. So if I shorten this to 9 years, you clearly see that American Express has been trading at about a 14 to 15 PE ratio over this time frame. Periods when it was below that were bargains, periods above that were periods of high valuation. It's currently just outside of the fair value range, but it's reasonably valued at these levels. With our next example, we're going to look at General Electric, and I consider this to be one of the most fascinating companies that I've ever analyzed in my career. There are so many lessons wrapped in this particular company's fundamental graph that I simply won't have time to cover all, but I want to highlight some. You see irrational exuberance during the period 1998 to 2000, followed by a sharp correction. You see good earnings growth during the days when they were really a financial company participating in all the financial excess that we had that led to the Great Recession, which caused both a significant earnings drop, a significant price drop, and of course, significant dividend cuts also in 2009 and 2010 before they gradually started increasing the dividend again. The stock was overvalued just last year, and it's now had a down year of earnings, of course, and now it's theoretically trading at what appears to be a fair value range. I'll shorten the time frame so you can see this a little clearer. It's trading right at a 15 PE, but Goldman Sachs analyst just indicated that he felt that there was going to be a dividend cut in General Electric. So there is another way I want to show you with General Electric specifically and the risk of that dividend cut. Now I'm looking at free cash flow. And when I look at General Electric with free cash flow, I'm going to take out the estimate data here and look at General Electric's free cash flow for 2015 and 16. And as you can see, it actually turned negative in 2016. Now they are expecting to generate about $1.20 of free cash flow this year, which might mean that Goldman Sachs analyst might be being a little harsh. But the same is true if I look at them from a standpoint of operating cash flow. Their operating cash flow has fallen rather precipitously, as did their GAAP earnings. So by looking at it strictly from a point of view of adjusted operating earnings, it does look like the stock is reasonably valued here. But I caution you to pay attention to those cash flows and what might happen with the company's dividend. Finally, regarding General Electric, it's just so fascinating to see how the price has really reacted to all these different valuation levels over time. Next, I'm going to take a look at both of the pharmaceutical giants, Merck and Pfizer, and there's a couple of very interesting things that I want you to note here. You see the irrational exuberance that we had, that significant overvaluation in 98, 99, and 2000. And then we saw the end of an era where this was a very fast-growing company. You can see the growth rates down here were double digits. But I want you to notice how earnings growth has flattened out in more recent years. I dropped this down to a 15-year graph, and we've got 3.5% earnings growth on Merck. Now, the stock does pay a 3% dividend. Their dividend record is good. It's not great, it's good. They have maintained a flat dividend for many years, but their long-term record of dividend production, like I say, is fair, but it's not great by the standards of some investors. They had long periods where they've frozen the dividend and periods where the dividend increases have been very meager, and of course that relates to the growth rate. Company is moderately overvalued here, maybe fairly valued, depending on how you want to look at that, or just fully valued, rather not fairly valued. I don't see it as a great bargain here, but it's not one of the massively overvalued stocks out there in the marketplace. And when I look at Pfizer, it's almost like deja vu all over again looking at Merck. Very, very similar story. We see this period of high growth. Their growth lasted a few years longer than Merck's. But then starting in 2014, we can just really see how earnings growth has really flattened out. So as I shorten this graph, you can see since 2005, earnings growth has been 1.9%. Increase that a little bit, going back to 2002, the earnings growth was 4.4%. So you can see that their growth has really flattened, and the stock price has traded as a discount as a result of that. If you look at the last 15 years of Pfizer, they've averaged about an 11 PE ratio. And so the company currently trades at a 14 PE, which would indicate that it's moderately overvalued on recent history, but long term it would be fairly valued at a 14 PE with a 3.5% dividend yield. But once again, I don't see a lot of growth going forward, and this will be primarily investing for income rather than total return. Next, we're going to take a look at property and casualty insurer Travelers. And the two things I want you to notice. I want you to notice how cyclical their earnings are. They have a good steady dividend growth record. They've increased their dividend quite nicely at a rate of about 11% per year since they've been paying a dividend. However, if you look at the way the market has normally valued this stock, it's been about a 10 multiple. It's currently at a 16 multiple, would indicate a very high level actually of valuation relative to the normal PE, but it's trading at a 16 multiple, which is not excessively high given the current market. But for this particular company, I might have to actually say I consider it overvalued. And then finally, we're going to take a look at Jpmorgan Chase, and I want you again to notice some things here about this company. I'm going to take the dividends off of this graph, and I'm going to take the normal PE and the price, because I really want you to see how cyclical earnings have been and how poorly this company has done during both recessions. Coming into the recession of 2000, 2001, and 2008, it's had relatively decent growth more recently. But again, you see that the price has been pretty consistently tracking that. The normal PE has been very close to the price. The company's dividend record is decent, but they did cut the dividend rather dramatically in 2008. So that's something else to consider. However, since the beginning of 2010, they've been steadily increasing their dividend. I do consider the company reasonably valued at this level, and there's other ways to value diversified banks, by the way, or any bank for that matter. I like to go into fund graphs, the financial underlying numbers, and things that I like to look at when I'm looking at valuations of banks is I like to look at the company's price to book, and I also like to look at price to sales. And I do want you to notice that in Jpmorgan's case, both their price to book and their price to sales, this is the price to sales, the burgundy, are at relatively high levels. So that would indicate high valuation. And even if I just shorten this time frame to the last 10 years, and I'll take price to sales off, you can see their price to book is on the higher end of their normal range also. So this would indicate full valuation, not necessarily significant overvaluation. But anyway, these have been the 6 Dow stocks that I've covered for you very briefly in this presentation, just to illustrate how different a lot of these stocks are, but also what relative valuations look like in contrast to the Dow itself. This has been Chuck Carnevale saying thanks for listening.